Hi everyone, my name is Piterpakulski. Today we have a final overview of a very simple financial model. So the legend of this playlist is very simple, so you know almost nothing about Microsoft Excel. You have a business idea, you need to figure out how much money you need to start the business. You have to somehow explain to your business partners what is the payback period, what are the revenues, what are the expenses, what are the profits. So you need to communicate. You first of all you have to persuade yourself that this business idea is worthwhile trying. And in this video I will just going from top to the bottom to see what inputs you can play with. So let's start. First of all, we have a unique rule through the whole our financial models. So all inputs are colored with blue. So all cells with formulas have other different color. We don't touch them. So we work only with blue cells, with input cells. As you can see here, we have values inside these cells. So first of all, on the top we have basic coefficients for scenario play for pricing, sales plan, revenues, direct expenses. So because we are done with cash flow statements, so we can, for example, see what will happen to our business idea if we take, for example, 50% of prices of our goods and services that go into to produce or sell. So, for example, if prices will be 50% of current scenario, if the sales plan will be, for example, 70% of what we have at the moment, or for example, prices will be 10% higher than the current scenario, and sales plan will be, for example, 30% bigger than we have in our current scenario. So we can easily play with huge sets of data without going deeper to the inputs. So this is like a core of the model where we can globally play with revenue. So for example, we can increase direct expenses, see what will happen to the payback period. So we can see here the value of the payback period, how much money we need if we, for example, increase direct expenses, or we can, for example, increase the expenses on payroll. We can see how payroll affects the financing, the payback period, and so on. So we can play here at the top with all the expenses, all the revenues globally, and see what will be the diagram. Also here we can switch between different scenarios. For example, here we have sales plans for pessimistic, basic scenarios. So here we specify how many goods and services we sell monthly in pessimistic scenario, basic scenario, optimistic scenario, and then we just switching between scenarios and look at the values of simple payback period, look at the amount of money we need to start the business. So we can just play with all this stuff just on the top. Then we have a core of the model, another core of the model, where we specify what we are selling, goods or services. G means goods, S means services. So we have, for example, 10 goods or services. Here we specify the price per good or per service. We can, for example, switch different services or goods from calculations. You can see also this changes. For example, we can see what happened with the diagram if we switch on and off different goods or services from calculations. We can also use coefficients specifically
for to play with specific good or specific service to increase or decrease prices.
We can use specific coefficients to play with sales plan for specific goods or service. Here is specific coefficients. These coefficients are global. these they are global, and also we have a bunch of local coefficients for prices, for sales plan, for cost of sales, for example. Let it be here. So here we specify the sales plan coefficient. Here we specify the percentage of direct expenses from the selling price. Here we have coefficient for direct expenses. We can increase and decrease direct expenses values. The final values of direct expenses are here. Then we specify the way we achieved these sales plans. So we have these sales plan, but we assume that we won't be able to achieve this sales plan right from the first month. So on the first month of operating activity, we will be achieving just 10% of, for example, these values. Then we will reach 20%, 30%. So we can play with this algorithm, and inside the cash flows, playing with this algorithm, we will be able to see the potential operating loss side the cash flow statement like this. So this will be an additional financing needed from your pocket or from the bank, so you can with the speed of reaching break-even point and see the difference in amount of financing you need to start this business. So this is very valuable, because when you start the business, you won't just get 100% the revenues right from the first month. So you will be reaching your planned sales plan step by step, and this step-by-step plan is described here. Then you specify when you get the first revenues, year, then month. Then you specify when you get the first revenues. Then you describe fixed costs. So for example, rent, utilities, advertising. So here will be the list of these expenses. Here will be monthly values of these expenses. You can also switch on and off different fixed expenses from calculations and see on the top the payback period, how much financing you need. You can also increase and decrease coefficient without playing with these absolute values. So for example, what will happen with business if these specific expense, for example rent, will go twice of this value, what will happen? So you can go up and see what will be the diagram. So you can switch off, for example, this expense and go up and see what will happen to the amount of financing you need to start the business. Then you move to payroll. Here you specify the names of positions you have in your business. This is a salary of one person on each position. Here you specify how many people on this position you're gonna have. Then here you specify, you can switch on and off different positions from calculations to see what will be the performance of financial efficiency with or without this or that position. Here you also have a coefficient for the salary for this or that position. So without working manually with this data, you can just increase or decrease this expense and see what will happen, or completely switch off this expense from calculation. So you have a variety of actions in case of scenario analysis. Then you have an investment plan. Here you specify what you invest in, how many, what is the price per unit that you are investing in, how many units you are buying. Then you also can switch on and off this or that investment item from calculations. Here is the coefficients that you're going to play. For example, you want to decrease the amount of money that you are paying to contractors, different contractors. You can just increase or decrease these values. without playing with all these absolute values just for scenario analysis. And you can specify the amount of loan that you are taking, that you are getting, what is the term of loan, what is the interest rate, if you have any grace periods for principal payments, for interest payments, grace period in months, here you can specify. Then you specify when you get this loan, year, month. Then you specify the rates of revenue tax, payroll tax, profit tax, asset tax, absolute values per month. And then finally you move to the cash flow statement, where you're able to see the structure of revenues, the structure of direct expense, absolute value of fixed expenses, payroll, and all expenses and revenues. Here you are able to see the profit from operating activity, how the business
breathes itself without loan burden that is described here. Here you are able to see how much financing from your pocket you need to start this business. Here is the loan. Here is the amount of money that you need from your side or from your business partner's side. Here you have totals from your money or your business partner's money, loan, and total financing you need to start the business. Then you have very simple table just for yourself, where you're able to see the revenues, the current revenues in this or that month, expenses, profit in your pocket. So what is the profitability of your business idea? Then you can see here the loan coverage ratio. It shows you how your profit is bigger than the amount of loan payment that you have to pay each month. So this coefficient must be more than 1 if at the moment when you have a loan. So if this value is equals to 1, this means that all you earn you pay to the bank. If it is negative, it means that you have even losses, and you need to rethink your business concept. So if this value is sufficiently more than 1, for example, it equals to 2, 3, or 4, this means that your business idea is quite stable and your bank payments, loan payments are insufficient inside your profit. So it's a good news for you. And here on the bottom also you have the simple payback period to see where your business idea has the moment of the simple payback period. And you can also go up and start playing with global coefficients. Then you can start with playing local coefficients. You can play with these coefficients. You can play with on-off switchers to see the performance of business idea or your business idea with or without this or that revenue item, this or that expense item, this or that investment item. So this will give you a huge amount of information about your business concept. It's nice time for you to rethink your business idea, to look how stable your business idea is. So if you use this kind of model, this will be a huge step forward for you for understanding your business idea, for understanding your business concept. So I suppose that maybe this video will be useful for you. You may give us a like, subscribe, share this video with your friends. You can order financial models from scratch for your unique business idea. We can help you with it. And also I'll be giving all the links describing the way I've created this financial model from scratch at the description of this video. So see you guys in next videos. Thank you and bye.